Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, August 14th, 2024. It's 1:11 p.m. Eastern Time as I'm starting the video. I'll keep it relatively brief, not a lot of new things to discuss, but I just want to kind of recap mainly on the equity markets, what's going on, what to expect, what my thoughts are, what the levels to watch are, et cetera, et cetera, et cetera, what I do day in, day out, the daily grind, I call it. Time permitting, I'll touch on a couple of the other things I've highlighted recently, nat gas. I give you an update today, but somebody asked my thoughts on that, like the longer term potential targets. Somebody asked about XLF, the financials, and so time permitting, I'll get to those in the end. Let me just start out here with what I call a relatively clean board on QQQ, meaning I don't have a lot of annotations. It's just kind of the bigger picture here. Big old divergent high, 2022, late 2022 to 2021 drop, ended with a big divergent low, gave us this rally, recently ended with this divergent high, and here we are. So we're going to zoom in nice and tight, talk about this a little bit. I've shared my thoughts pretty much ad nauseum lately on where I think things are going, potential for a top. The evidence being multi-year divergences, valuation extremes, sentiment extremes, AI hype bubble. I'll talk a little bit on that. Hopefully I don't, my brain kind of goes off on tangents, but I'll talk about Google yesterday with their annual tech event. And pretty much, I'll just tell you in a nutshell, they're giving their AI away for free now, plowing gazillions of dollars and resources into it, and all that, and they're yet to monetize it. At least that's the way I'm seeing it. I'll talk on that in a second. All right, so but from a technical perspective, we have the uptrend line there on the daily, the wedge, the breakdown, impulsive, and then this counter trend bounce. We reversed, covered shorts, went long here, gained the bulk of the bounce so far, and I've been, as mentioned, scaling back out of longs back into swing shorts for what may be the next leg down. We'll see. What I can tell you factually is, as I said yesterday, again, that's why there's not many new updates. We are back testing the 50-day exponential moving average. That's this yellow line right here. We took it out on this big red impulsive candle. Once we gave up, that was support when you're above it, and it's resistance when you're down below it, just like you got rejected there, just like you got rejected there, got rejected again, and here we are. So there's that. You have a back test of the primary trend line up off the January lows. That's where the NASDAQ 100 really took off. Pretty much put a double bottom in from October, the previous October. And if you look on all these little dashed lines, you have to look over here. I know you can't see it in the video, but I'll read it out to you. It's these are Fibonacci. It's a Fibonacci cluster. So from the very high down to the recent low right here. That's this yellow line that measures that. And then I have a second set of fibs from this key reaction high right there down to that same low point, obviously major levels. And when you zoom in real tight, I'll scroll over and you can see this is the 50% fib of the entire move down. That's the yellow line, and the 78.6 to Fibonacci retracement levels, both of which we're at right now, and we were pretty much a hair below yesterday and made a full complete tag of those today. So that's what I call a somewhat clean board. And as I mentioned yesterday at the close, we were within close enough to say it's a test of the trend line, the downtrend line. I'll give them points today. We're above the trend line, but we'll see how the day closes. This is a daily chart, so all that matters is how the daily candle closes. I'm going to bet on a down today into the close. I'll tell you why here in a second. But as I said yesterday, again, you have a nice, clean, well-defined uptrend line off the recent lows as well. And as I just showed you on the other board, you're back testing. This is that primary uptrend line on QQQ as well. So we have again, a confluence of resistance, be it Fibonacci clusters, as I just showed you, 50-day exponential moving average, and a back test of the trend line. And then you also have a support level in which, if it breaks, would trigger a sell signal, especially a solid break intraday, or even better to see a solid daily close below this uptrend line off the lows. All right, that's QQQ and kind of the overview of it. There is a bullish crossover in play right now. You got to give that, that some quite often it indicates a trend change on the daily PPO down there. But if this plays out, I've seen plenty of those, bullish or bearish, where you get the crossover and then it proves to be a false signal. So again, there's just a lot of levels to watch, react. All I can say is if you take out that this confluence of resistance that we're at now, especially if you get back above that trend line, you get above those fib clusters, you get back above the 50-day on a solid daily closing basis, all that. Yeah, you still have a pretty good support level, like I said. My plan, as I told you, scale up to that downtrend line, but not above it. I'll sit tight for now. This is really nice resistance if there's a little more oomph or a little more upside left in the NASDAQ 100. But now let's talk about why I think the technical catalyst. I'm sorry. Technical catalyst would be, for example, break of the trend line. That would be a technical catalyst for a drop down, a sell signal. A fundamental catalyst could come tomorrow. We'll talk on that real quick. Okay, so today was the CPI. I don't think anybody expected a hot CPI. Home prices have been falling, especially in the hot areas. I'm in Florida, where post-COVID, everybody moved to Florida and Texas, left the high-tax states, bad weather states. It was a stay-at-home thing, and our real estate market exploded, just like it did in 2006, 2005, 6. With the before the dot, which led to the bursting of the debt bubble back in 2007, 2008, with all the bank failures. And we're already seeing. I very actively monitor trends on Zillow, national, regional. Look at hot markets, and I've seen we've clearly turned, especially here in this area. Tons of price drops, days on market soaring up. And so it's not a crash or anything like that, but it's you can say definitively the real estate market here is peaked. So we know that home prices have fallen. We know what crude has done and commodity prices. DJP, I track all those various commodity indexes, which actually I'm going to go on a tangent. I'll throw that out as a potential trade idea. But so again, we CPI came in at expectations, so it's really a non-event today. We're up a little, down a little today. We're flat right now on the markets. Nasdaq, as I talk, is down slightly, and the S&P is up slightly. The big stuff is tomorrow. Tomorrow is jobless claims, retail sales, Philly Fed Manufacturing Index, and the Empire State Manufacturing Index. So a slew. Oh, industrial production as well, guys. I left that one out this morning. For those of you sports fans might remember Mike Tyson's famous quote before his fight with Evander Holyfield, where somebody asked about, Holyfield's plan, and Mike Tyson said, everybody has a plan until they get punched in the mouth. All right, so the market got punched in the mouth. We saw the biggest drop. We had a crash in the Nikkei. That was the biggest one-day loss going back into the, I think, 80s. And one of the biggest drops in the U.S. markets in such short order. So, you're not going to argue that. And the market got up. Why did the market get punched in the mouth? Well, we were already on sell signals. The charts got us ahead of the big drop with everything I covered, the breakdowns and the bearish engulfing candles and the video breaking down and everything else. But it was the job market. So let's talk about that, and let's talk about why, I would be surprised if we didn't see some nervous profit taken before the close. And look, this can go either way. I said it before. I said it this morning in one of my posts, and I'll say it again. We can certainly go either way. This could be a cool, the jobless number could actually come in better than expected. And jobless claims or any of these guys, it's a whole a whole litany of reports culminating with this industrial production after the market open. I'm sorry, 15 minutes before the market opens. These guys come an hour before. Jobless claims, retail sales, Philly Fed Manufacturing. Then you have industrial production at 9:15, and even some other stuff out there after the market opens. So obviously, it can go either way, but like I said, the market was punched in the mouth. Why? It's the jobs market. It's everything I've been saying for drums I've been beating for 6 months at least. That, hey guys, we're seeing. The first of all, I said that. I've showed over the last year, I've showed this chart many times. And when I do turn on bubble TV or read a headline, with the usual permables out there saying why we're not going to have a recession, why it's not in the cards for 2024 or probably even not 2025, and why the stock market's going to continue to go up, it's because they keep citing the unemployment, the jobs market's so strong. But as I've and I don't just say this stuff, I highlight it, point it out. Every recession, every market top comes from record low unemployment. And it's not only that. So, unfortunately, there's not a hard level where you can say, oh, every time it gets to this point here or this point here. But we can see when just looking at this chart, this is, this is the U.S. national unemployment rate. Okay, we're going back all the way to the 40s right there, 48. And every cycle is different over time. Things change, and the way they do this, account for it changes. But what doesn't change, and what I've highlighted multiple times, is how it works. And it's a pretty clear and persistent downtrend, right? And again, every bull market ends with euphoria, a strong job market, the same talking heads that come out and say, well, here's why we're not going to have a recession. They say it right here. But what they don't realize is that is when you need to be on high alert, that this is when it's healthy, when you've peaked, you've had a recession. The recessions, by the way, guys, are shaded in the gray areas. But most importantly, what I want to convey here, and this is what I've said in advance, and it's finally happened now, is that when you turn, you always turn from the near record low. That's where during a major cycle bottoms. But when it turns, guys, it doesn't turn like this, go sideways, zigzag. It's pretty much a V. Okay, in every instance, you can look here, pull this chart yourself. You can get it from wherever you want. This is macrotrends.net. It is a V. And on the upside of that V, it's every bit, if not stronger, than the move leading down. So, that was then, this is now. You're looking at it going back, 70-something years. Let's just zoom in nice and tight. There's the trend, guys. This is where, there were a few, dismissive. And this is the last one that's really started this uptrend, the acceleration. That's what this is all about. It's about two things: a trend change, where you can see the trough right here, right? Back last, in January or so. And then you see a clear uptrend, or at least that's what I see when I look at this. Now, it's not off to the races kind of thing, when you zoom, but it is an uptrend. It is a clear bottom that's now been over a year. So you can see the tick coming up. And again, you can go and look at it, play around with these numbers. They're going to be, the data is the same on all the charts. You can see a pretty clear reversal. And history shows us that once that bottom is in, and it's not just a blip, an aberration. These are aberrations, guys. When you get, first of all, don't look for it until you get down around the 4% range. That's in recent years, especially, that's around the low. This is where you want to say things are rosy, hunky-dory. The employment job market is strong, but you don't want to start worrying about it here. You want to start worrying about it when it gets down to 4%. It's just the natural cycle of things. And that's where it bottomed out. It bottomed out where it did last time around. And there we are. So there's the uptrend. So here's where I'm going. I don't know where the numbers come in tomorrow, even though I maintain no matter where they come in. I don't care if it's a down number. It's not, it's not going to do this. It might be a little blip, and it may give you a thrust. If this comes in, remember, there's other things tomorrow that could impact the market. But if we come in cool, it's not as bad as feared. Maybe we get another jog up. But bigger picture, when you're looking out, months and weeks and even months from now, unless this trend changes, and if it does, it would be very unusual. Again, citing all the reasons, going back as long as you want here, it would be very unusual to see such an uptick, because this doesn't look like any of these little. I'm not calling them aberrations. They were just little ticks within the trend. You can see little tiny ticks. Typically, once you've turned that much, that's it. And then boom, then it starts to really accelerate. So What I'm speaking about now is fundamental stuff, and I'm marrying, as I always do, fundamental analysis, which is macro, economic data, with technical analysis. So that's it. You guys decide what to do. Decide what to do with your 401ks, active trading. As always, I'll try to thread the needle. Been highlighting, objective levels to cover shorts in recent weeks, objective levels to play bounces, and objective levels for both active traders and swing/trend traders. And that's who I've been speaking to, with this video and most of these videos lately. Okay, so we'll see where we come in. 4.3 was the last reading. You can go there and click on and we'll see where. Again, this is just one thing there. And again, even a blip down is not going to change the near-term trend, but a blip up. So in other words here, the risks, they're somewhat bilateral right now because a cool number, the near-term momentum is up. There's no doubt about that, right? But the intermediate term, we've had some pretty good sell signals recently, and I can tell you a hot number. So here we're looking at right here, consensus is for 234, so an uptick. So they're, factoring in, we're going to continue to see initial claims tick up. We'll watch ongoing claims, and we'll watch everything else. And again, I don't want to spend too much time on this, but know when it's kind of like trading a stock into earnings. In other words, we didn't have tomorrow's economic calendar is so heavy it has a lot more potential market movers than today did with the CPI is what I'm trying to tell you, because the CPI again was and CPI usually comes in pretty tight there, and Fed is their preferred inflation gauge is a PC anyways. All right, let's move on. Let's go to a few other charts, and let's talk about the big market leaders. We have Apple. I just want to show you we have comparable uptrend lines on a lot of the market leading stocks. This is a daily chart on Apple here. Uptrend line, which we're walking on right now, just like QQQ. We're actually starting to crack a little bit below it the way I have it drawn here. But again, you have to squint, and then you give it the benefit of the doubt. I think I have a board here somewhere in here with some fibs. Yeah, there it is. Apple, since it peaked right here, there's the peak. Put that fib right on the top. So far, Apple has stopped at a 61.8 fib retracement, which is a typical counter trend bounce, if I'm correct. And this is just a counter trend bounce and a bigger move down. That's a key fib level. Microsoft today has retraced, as of today, the 38.2% Fibonacci retracement. Again, off the highs. That's usually about the minimum you'll see for just counter trend bounce. Let's look at the other chart. And also has a comparable trend line, which is above right now. But again, bigger picture, it gave us a pretty powerful sell signal here. Break of the wedge, minor trend line, break of the more significant longer-term uptrend line off the January 2023 lows, and still well below there. Again, this is just reflexive bounces on or around the 200-day moving averages as anticipated. And again, if we break this trend line, that would be a potential sell signal there. And the reason I do these videos and cover all these, it's collectively the majority of these, not any one of them. I'll get to Alphabet, which has already broken its comparable trend line. There's NVIDIA. NVIDIA, of course, hit very good uptrend line support, price targets that I gave you before, both on the 60-minute chart and the longer-term weekly chart. And it's now back to that 117, we'll call it about 118, as I've been referring to it as, about 118-ish resistance level today, right there, which I said it would be the next stop if it took out the trend line, which wouldn't surprise me. And then I gave you this 125-ish level, which is the max potential bounce target, and I don't think it'll get that far. NVIDIA, I do think it's a good time to re-enter. In fact, look at this. We're back to my first target zone from last short trade there. We hit the second target zone here and the third target zone there. Covered the video, went long with the market back the day of the lows, and we've rallied all the way back to the good resistance. Remember, when we hit that, I kept talking about it. It was my first support zone and target zone. Hit it, hit it, hit it, hit it, hit it. Finally broke it. And that was a sell signal to open the door, and we hit T2. We bounced back, got rejected off. Remember, support, once broken, becomes resistance. So to update this. That's now a support slash resistance, or really a resistance zone. Anyway, so that's where we're at on NVIDIA. And let me go back to the daily. I don't know if I fibbed it up, but let's see. What board? Might not have drawn fibs on NVIDIA. Either way, I have it on some of the other ones here. Here's Alphabet. Alphabet primary downturn line off the tops rejected. I mean, just a major, big, beautiful bearish rising wedge, divergent high, sell signal. Remember, these are the market leaders, and they've gotten the snot knocked out of them. They went to where, and had to bounce off the first, tradable reaction off the 200s like I've been expecting, and we got so far. And again, I think it's just a reflexive bounce and 18% drop. So this is, again, the market got punched in the teeth, Alphabet and all these big tech stocks did. And as expected, the dip buyers are going to step in and buy. They're going to buy the 200s. I can't recall a time where we just went through them like they weren't there, especially after a 20% drop to get down to them. And now you can see we got rejected. Our Alphabet did off the trend line and that minor uptrend line, which is comparable to the uptrend lines I gave you on the other guys. I don't know if I put fibs on this one. Let's see. There. Wow, pretty weak, muted 23.6% Fibonacci retracement on that one. So yeah, on Alphabet, I was talking about, I call it the AI race. It's like the space race between Russia and, the United States. It's where that Apple series that they're running now is all about. And it's the AI race. I've recapped it many times over. Most of you heard, so all of a sudden ChatGPT came out with this fun LLM, and everybody thought, oh my God, AI is this new thing. It's going to change the world. And then, they found out Microsoft had a stake in there. And then Alphabet's, put out code. They called it code something. It was that important. They diverted major resources, pulled plugs on a lot of projects, diverted everything into AI. We gotta do AI. We got to do AI. Of course, Apple followed everybody now, is trying to put the words AI in their reports. And to me, and I've said this repeatedly, it's this, I've yet to see any useful, and there's some, I'm not going to completely dismiss it, but let me just summarize this and say that, so Google just did their big annual event yesterday, announced their latest generation of phones, the new watches, a couple other things, but they spent just pretty much the entire thing talking about AI. The phones there's nothing new in the phones. They got, of course, like every phone's got a newer chip, a little faster, but it's all about AI. And what they're doing, you buy the phone now, and they've now retasked even their Google Assistant. It's going to be called Gemini. Remember, Gemini was Bard, and there was some nickname. Bard was such a there were so many errors. Everyone was calling it Tard. It didn't work. And so they retasked it to Gemini, renamed it, and trying to put lipstick on that pig. Well, where I'm going, guys, they're giving it away free. You buy a new Pixel phone, you get a year plus of the Gemini Advanced model, because they're just wanting everybody to use this thing. And if it was that good, they'd be selling it. So it brings home the point. What I've been saying is that the market is going to realize there's so much hot air in these stocks because they're priced in like AI is going to send them to the moon and beyond, and they've been plowing tremendous amounts of money and resources into it. And where's the return? And I've asked people on this site, I haven't had any feedbacks. Are you paying for the best? And it's not even AI. Everything is with the label AI. To me, is just it's just advanced search queries like what Alphabet's doing. I'm listening to and Apple's going to be doing the same thing when they roll out the new generation of iPhones soon. Is that they're just advanced search queries. That's what Google's always been good at. In other words, it's AI. What it's going to do now, and they're calling it AI. You ask something, it'll parse your Gmail as well as your Google Calendar and your text messages, and then pick up that you text somebody, hey, let's do dinner, blah 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 on this date, and then it puts on your calendar. That's just cross search functionality between apps. I don't think that's really artificial intelligence, but it's being labeled that way. And so anyway, I think the public, whatever, if they sell it, great. If you are buying a premium membership and you're finding a lot of value, and I hear a lot of people are doing that, so be it. Maybe it is a real thing, and maybe they are going to receive a positive return on the investment. But if not, I'm talking macro stuff. Longer term fundamentals is going to play out and bring these companies down a lot further until they really, can capitalize on that. All right. So that's it. So Google already tested, still above. A lot of these guys, hit, and they're still above the 200. So as I've been saying, if you see more and more of these minor trend line breaks, that's certainly a technical breakdown, sell signal. But you really need to take out the recent lows and put the 200s clearly in the rear view mirror to open the door to my longer term, deeper targets. Right now, I'm just kind of focusing on some micro, what I call near term levels, developments to watch going forward. Alphabet, I already covered. Amazon took out the 200s in one fell swoop and is back testing right now. And you can see tried to get above this. It's the red and the blue line here, the simple and exponential 200-day moving averages. They parked on them yesterday, tried to take it out intraday, but smacked down so far, and we're right back on them. So we'll watch this one to see how it closes as far as retracements go. And I've stated that this one is, of the big tech stocks, has the most bearish technical posture, in my opinion. Let me see. I must not. Yeah, there's your fibs right there. 38.2% retracement so far, right there. And we're right below that. So this one's back testing key Fibonacci and 200-day moving average resistance. S&P 500, this is the all-time high. This is the recent low, right at the 61.8 fib right now. That's where we're at on the SPY. And let's cover the other stuff, and we'll wrap this video up. I told you it wouldn't be too long. Give that update on UNG. Somebody asked my thoughts today. This has been this trade. You can play it like a grand piano. We had the natural gas, of course. I always say, you want to keep an eye on the natural gas aligned targets, but we hit the comparable, I think it was T2 on NG futures today. But you can see we go up, you hit T1. This was R1, our entry point. We hit T1, we pulled back to R1. R1 meaning first resistance, so that's really R1, S1, right? Because resistance once broken becomes support. And so, if you're active trading, sell that, buy the pullback to support, then rallied up, hit the second target. Where did we pull back to? The first target. And this is why I have these multiple levels. So, they're all levels where a reaction is likely upon the initial tag. T3 was hit, and so far, pull back. So now, I will say that I think it's prudent, in my opinion, to keep some on, because this has been such a obvious pattern, and at some point they may just ramp this up, because what happens once it starts to get going, and once the masses start to realize nat gas is now in an early makings of a new uptrend, you can start to see this buying accelerate, kind of like the way selling accelerates on the stock market to the downside. So I took some profits at that level today, but I left some on. I left some of the position on, and I'll add that back there. Or if I see it start to turn up and I see an objective entry or reason, maybe a break over the recent highs, I'll add back. Oh, so the question somebody asked me was, is Randy, because they could see that 1740 level, do you think we can go up there? Oh, absolutely. I think that's, I mentioned that in recent videos based on the daily charts of natural gas. With $2 being a good support level, coming off a big divergent low on the daily, even weekly charts. And it's the nature of natural gas trends to run high double digits or even easily into the triple digits on the trend. So remember, today was only if we look at the trend, it's been about 20% off the lows. So yeah, there's very much a potential for that. And likewise, guys, this could be the end of the run. That's the thing about any of these targets. Sometimes we don't always hit my maximum targets. This is still very much a potential and likely target as well. I may extend it. But we do have negative divergence. Now, remember, this negative divergence comes on the heels of much larger positive divergence and a powerful breakout. There was our entry point right there. Went up, hit T1. Had a consolidation, had several pullbacks to it, hit T2 today when T3 on UNG was hit. Remember, these targets don't necessarily always align. I also gave you, this is this is the 6-month, 2-hour candlestick chart I gave for typical swing traders, active traders. I said you can use this. I gave you the hourly chart, 60-minute chart, and you can see there. So there's negative divergence, and that's why, again, for me, just lighten up. And if we pull back, I can recycle in lower, or if we pop out, especially if the divergence is taken out, and I can easily see more upside to, that 271 level right there. Possibly more. We'll see how it gets going. That's also, you can see about 270 right here on that 2-hour chart. So that's nat gas. And a few days ago, I floated a crude short out to you. We had recently went long right there with impunity off the lows. Exited, hard exit when T2 was hit there. Sidestepped that give back. Then we had a divergent low here recently, but then we rallied into it. So the other day I said it's an objective short in the T2 zone up to the trend line, because we're so close to that downtrend line, and that's what we hit. And then when I told you I was just looking for, I was initially open to a bigger drop, but I told I just wanted to play the quick pullback because I had averaged in a lot more at the top. But it, as expected, it did break down, and it's moving down pretty good right there. And it tends to almost be an inverse correlation with crude oil and natural gas. And I think it's due to the crude prices. When prices are up, they pump it out more. Natural gas coming out of the ground is a byproduct, and so there's a lot of nat gas out there. But when crude prices fall and production slows, then you see nat gas goes up. So it's it's been happening recently. Either way. Where to, I don't know. If, like I said, if I think I mentioned, if you can just set a stop and let it run, I can't make heads or tails of this right now. I don't have a strong opinion on it. And that's it. The other things I've been kind of lukewarm on, but not hot, is wheat, corn. So they're all still coming up those divergent lows, but they've been doing that lately. Put in these divergent lows, rally up to the early targets, and then pull back. But they still look constructive. For bottoming place. Oh, and I mentioned, get back on my tangent, commodities, one thing I look at, to try to gauge where inflation is going to come in at. In the past, when I have a strong conviction, I make these calls where CPI will come in hot or cold, and I can, I've used DJP, it's a broad-based commodity index to look at. These are monthly boxes here, and you can see here, I'll do it on a daily chart, and you can see them better. And you can see month, how much commodities go up, and they're not the biggest, but they're a big component of, especially because crude oil has a big weighting in here. And I just wanted to point out, this was July. So July, again, how could you expect a hot CPI based on what I said about home prices falling? If you watch Zillow Trends and watch markets, Redfin, all those, that was a drop in July. But where I was going with it is it's starting to look pretty attractive here. The commodity as a whole, this is good support. This is they've been in this range here, and then coming down. DJP has been coming down to this 29 level support, and I highlighted it here. We had the positive divergence, bullish falling wedge, a breakout. That ended with a divergent high. So it's not like gold. It's slogging around sideways, but it's in a range. And TA 101 or trading 101, when you find a trading range, it's simple. Don't overthink it. Unless the technicals are pretty clear, pointing to a breakdown below the range or a breakout above it, the simple strategy, especially if you can confirm it with other technicals like divergences or momentum indicator crossovers, things like that, is you go long, cover shorts and or go long at the bottom of the range with a stop somewhat below, and swing it up to the top of the range. And then you can turn around and reverse it if you want, if the indicators confirm that, or if you think a breakout is likely, you can wait in position for a breakout. So I just wanted to mention, it's thing about commodities. Again, this was the whole juice for the market, abating inflation, abating commodity prices, but they've been holding in this range. And when you look at the bigger picture, which I've covered many, many times in the past, this is the bigger picture. This is where they peaked back here. We had a bear market that ended with the COVID lows when the stock market bottomed in March of 2020. And by every single metric and technical analysis, this is a new bull market. That was a major low. All the previous high, the primary downtrend line was taken out, which tells you you're probably in a new uptrend. And then all the previous reaction highs were taken out. which says so when you start making higher highs and taking out the previous highs, yeah, that's an uptrend. Now, this is just a period of consolidation. Where we go from here, I don't know, near term, like I said, intermediate term, until we break this range clearly, you break to the downside clearly, you're probably coming all the way back down here, about 26. That's possible. If the economy falls off a cliff, crude prices should go down due to demand destruction, unless there's anything crazy going on in the Middle East. But otherwise, market forces could take us up here. So anyway, just wanted to point that out as a potential trade idea. And that, wheat and corn and soybean, I've been focused on the grain. They all fall in here. They're just a much smaller weighting here. And these broad-based commodity ETNs and ETFs, they usually track the major commodity indexes, which have a high weighting in energy. That's usually 50% or so in a lot of these. Yeah, I'm going to wrap this video up by just because I didn't cover the futures lately. I know a lot of you do trade futures like I do, and so I just wanted to say this is the daily chart, and I zoomed in. I was first giving it to you when I laid out these targets. Remember, I have deeper targets, but this is T1, T through 5, and 6. We hit T6, remember, to the button. That was in pre-market, the day of the low on Monday, and that was a reason for reversing, covering all shorts, going long to gain this bounce. And then scaling back in about right here recently. And there's the downtrend line off the highs. So I wanted to point out that NQ is currently testing that downtrend line off the highs. T3 was a support level and now becomes resistance. We're a little close to that. And we also, I believe, here, I'll throw them up for you. I think I'll do it on a different board. I believe we're also at a fib retracement there. I know we are on the NASDAQ. QQQ I already showed you. Here, let me throw it up here. I'll throw up fibs for you. For kicks and giggles, I don't want to move that line. Yeah, that's the problem. I'm gonna have to move that line. I can tell you we're at or around a key fib on the futures as well. But right now I can't do that without moving all these lines around. It's just kind of a limitation of drawing tools on this chart. Thought I had them up on here. Yeah, I do. Oh, looks like I moved that one. That was right here. Put it back to the 50. There it is. 50. All right. If you see what I did, I had dragged it. It's at the 50% retracement right now. Again, that's the entire move down from the highs to the lows, a perfect 50% Fibonacci retracement in the futures. You've got now divergence building. You had it building here on the PPO recently. Now you have it on the RSI and the PPO on this last thrust up into that fib retracement level there. You have this minor uptrend line and then this larger uptrend line off the lows in which to trigger sell signals if we get rejected here. So I'm going to wrap the video up. I don't expect any big fireworks today. I would suspect you're going to see some nervous profit taken into the close based on the big economic reports tomorrow. But that's just a matter of really, are there more nervous longs in the market right now that got in recently, want to take profits? Or maybe longer term investors that got snot knocked out of them in that last move down and afraid to be holding into the next big economic reports? Or do you have more short sellers that what I call JCL, the shorts that were shorting when we were covering last week? They got in too late. They wanted to short, and now they're underwater, and they're nervous, and they're going to then cover. If they cover, that causes stock prices to go up. My guess is at this point in the rally, most of the shorts have been squeezed out, the Johnny-come-lately shorts, and active traders like me that have gamed the bounce, if they're still in it. Even if they didn't get the bottom, they're probably going to have that nervous selling before tomorrow's reports. And then, boom, when the reports come, like I said, you know which way I think they're going to go, but we'll see. And then we'll react and adjust accordingly. This has been Randy Finney with Right Side of the Chart. Have a great day.